I'm joined by Connor Campbell. He's a financial analyst at spreadex. Morning to you, young
Morning.
Connor. Right, we're going to do equities. A number of companies are reporting this week. Let's kick off with the Tesco's chart. They're up 7% in the last 12 months. Weekend press speculating that they thought Tesco's were going to be a winner this Christmas. Are the buyers coming in still?
Yeah, it's interesting. Like that 7%, a lot of it's come in the last 2 months. I think it's since mid-November. Basically, you can see sort of that gap at the in the middle of the chart. I think that's when you got provisional approval for the Booker Group takeover.
Yeah.
Since then, it's climbed 19% in the last 2 months because during that period, you've also had confirmation of the Booker deal. You had Goldman Sachs shifting their rating from sell to buy, which was that gave it another boost in mid-December. So it's had a very, very strong end to 2017. Like you said, the figures this week are meant to be very strong. Continuing really on from like its half-year figures back in October, they weren't bad at all. I think for the half-year, like-for-like revenue was up 2.2%, and that was pretty consistent over the first and second quarters. I think the first quarter figures up 2.3%, 2.1% in the second quarter. That's only a minor slip, and 2.2% in the current climate as well, and in the sector it's in. I think a lot of companies would accept flatter sales, so 2.2% is very healthy. I think underlying pre-tax profit was up nearly 24% to 759 million. That allowed it to issue its first dividend in 3 years of 1p per share. Very, very strong half-year reports. Didn't necessarily translate to a great performance market-wise, but the figures, they were very healthy. In terms of this week's sort of the Christmas period figures, I think like-for-like sales were meant to be up 2.4% for the third quarter as a whole and for the key Christmas period. Again, that's great. There's an improvement on what they saw in the half year. All signs are pointing to Tesco, really again solidifying their place at the top of the sort of the supermarket food chain. They've got the clout to, they had the clout to withstand sort of a rocky 2017 for the sector, with inflation, eating into their margins and things like that. From our client's perspective, there are buyers around the 210 mark, but I will say there are sellers as well. I think, again, it's because it's climbed 19% in the last 2 months. If it, disappoints slightly, I could see a situation where even if its figures are great, the slightest bit of bad news, one errant comment in the third quarter figures on Thursday may give investors calls for pulls and pull back slightly. But I'd say the majority of our clients are buying around the 210 mark.
Okay, well, let's go on to Boohoo. Boohoo.com, they are up 46% in the last 12 months. Wowee.
Yeah, which, you wouldn't necessarily think looking at the chart. They had a big old fall in September. But that shows just how strong the first 9 months of 2017 were for Boohoo. Those figures in September, that drop came after its half-year figures. Half-year figures were typically for Boohoo pretty astonishing. I think revenue was up 106%. I think it was to 262.9 million. Break that down. I think for the Boohoo brand revenue was up. I think it was 43% to 189 million. That's the core of the company. But then it's sort of its recent acquisitions bore fruit as well. Pretty Little Thing. I think revenue there was up 269%. That was one of its acquisitions. Sort of a bit of nepotism there because that company's owned by the son of the founder of Boohoo, but it's been a very lucrative move for them. Nasty Gal, it sort of bought a lot of intellectual property rights from Nasty Gal. You see sort of adverts for that plastered all over the tube. That contributed another 8.4 million. I think pre-tax profit was up 41%. Really, really healthy figures. However, I think because it had climbed so high, investors were maybe looking for, okay, so where are the danger signs here? And margins were down. I think it was from 55.3% to 53.3%. That was because Boohoo, it wasn't necessarily a surprise. Boohoo had been spending on advertising and promotions and things like that. But I think perhaps investors were looking for the chink in Boohoo's armour. It's done so well in the last few years. And that maybe caused a disproportionate reaction in September and dragged it back below the £2 mark. From our clients' perspective, they're really, really heavily buying this around the £2 mark. I think because it has fallen from those 260 highs, and I think it was maybe at 270 a bit earlier in the year, they may be looking at this and thinking this is maybe a bit of a bargain heading into what could be a very strong Christmas period for it. I think the BDO reported that online sales over the Christmas period were up 40%, and Boohoo stands to really benefit from that greatly. So our clients are really, really heavily buying around the £2 mark. Okay, well, let's wrap up with my favourite, something I do understand a little bit of, Marks and Spencer's. Down 6% in the last 12 months. What are the clients doing in this? Yeah, it's interesting. Sort of Marks and Spencer's.
Because the numbers are out Thursday, aren't they?
Yeah, numbers are out Thursday. Bit of both of Tesco and Boohoo sort of covers both sectors there. It's half year figures back in November. For Marks and Spencer's were pretty decent. I think revenue overall was up 2.6% to 5.1 billion. There was signs of progress in the the beleaguered clothing and home division. Though like-for-likes were still down 0.7%, that's a drastic improvement on the 1.2% decline seen in the first quarter. I think in the second quarter they only dipped 0.1%. So, fairly decent. However, whilst it announced that it was sort of speed up the closure of its sort of underperforming clothing stores, I think investors were fine with that. It also announced it was slowing the expansion of its Simply Food stores. And that came as a bit of a shock. Simply Food, despite sort of constantly hovering around like a 0.1% decline like-for-like sales-wise, the food division is its sort of its shining star. It's its bright light in the darkness. And the fact they were slowing the expansion of that division was a bit of a nasty surprise for investors. I think the company said it wasn't the right time, given the climate, to sort of have another pipeline of new openings in store. I think margins suffered, trying to not pass on food inflation to its clients. You can see that's why it saw quite a sharp decline in November. In terms of what it's going to do this week, its figures don't look great. I think year-on-year clothing and home sales are meant to be down 3.4%. The food division is meant to be down 1.1%. If you compare that to what's expected for Tesco and the 2.8% like-for-like growth from Morrison's, the Marks and Spencer's food division is a division on paper that should do very well over Christmas. It's slightly more upmarket than its peers.
Yep.
People that want to, maybe get something a bit special in for Christmas might go to M&S. The fact that people aren't, I think, reflects the tougher economic climate that has sort of been brewing in the second half of 2017, that looks likely to continue in 2018, and Marks and Spencer's sort of inability to really capitalise on its food brand for the last year or so. From our clients' perspective, they are buying around the 310 mark. I think part of that is going to be informed by Next last week dramatically beating estimates, really, and far surpassing what analysts were expecting. So I think that may be why you're seeing clients buy around the 310 mark. But I think it really is going to depend on how the food division performs, because I imagine investors are sort of accepting that the clothing division might have not done too well over Christmas.
Connor, we ran out of time. Thank you very much indeed.
Thanks very much.